I think you look back at the Powell comments from last week, and he talked about we're far from neutral, we're removing accommodation, and the market just seemed to interpret that as we're not in Goldilocks economy anymore. And I think that resulted in the market getting a lot more rate sensitive. And rate sensitivity is an issue because it's going to test the stability of the credit cycle, because you've had so much CCC issuance, particularly underwriting the stocks that have really been moving the market this year, which has been small cap growth. So I think the takeaway of the market, and probably for investors, is I don't know if we really know where rates are going to go next. That's a lot of macro factors. I don't know if anyone can tell you definitively. I think we do know that growth has been above average for a long time. Rates have been below average for a long time. It probably makes sense to have a portfolio that can get some benefit from a rising rate environment. That's not super easy to find, but it probably means an upgrade in quality, right? And making sure you're not over-levered to poor credit.
You know what's interesting is that Michael just touched on Powell's comments. October 2nd, that's when the market fell out of bed. So all of this stuff has been swirling around. IMF is the new thing, but China has been swirling around. We've heard everything else, but October 2nd was the date.
Yeah, for sure.
Is it all about Powell, or is it can't be all about things that we've already seen?
But Stephen, I mean, talk about the market moves of the last couple of days, because we've had quite big falls, but then intraday recoveries, which you could frame as encouraging. But the one thing that has been true through both days is very divergent sector performances. It's not like the whole market's moving in step now. So whether or not the market's topped out or not overall, is now the time you really have to pick and choose going forward?
I think you do have to pick and choose, but you're going into year end, and we've seen hedge funds going out of business at a pretty good tick. The average hedge fund return is 3% this year. So that's going to incent people to take big stakes or get rid of what they've already owned in the open market. I think you're going to have to invest in this market if you want to beat the index. Index is up 8% or 9%, somewhere around there, depending on what index you follow. We're in October. So we've talked about this. S&P, best seasonality 5 years backwards is October. November is best for IWMs, for the small index. You're going to have to be in this market if you want to beat your index point blank.
So, Rick, rate sensitivity is the new name of the game. Where are they going? Where are yields going from here?
Well, they're going higher, but I just think that this is a strange discussion to have. Think about what Steve said. He said rates are either going up because of a good reason, which is growth, or a bad reason, which is inflation. Let's think about that bad reason for a minute. If it's such a bad reason, I just don't understand why every central banker in the world is going to church or synagogue every week praying for it, seeding the field to see more of it grow, disappointed when the stocks aren't taller. A little inflation is good. You own a house, you own financial assets, you own the stock market. It's going to take better care of you. This notion of rates going up being a bad thing, I understand it. But don't think about it so much as rates. Think about it as all the costs. Hey, pretend you have a floating mortgage and rates are going up. How do you feel? How would you feel if you had a fixed mortgage and rates are going up? What's happening is margin calls, deleveraging. These are all very welcome signs. Think of the discussion we'd be having if the economy was cooking in grease and rates weren't moving up. Like pre-2016, the election. Then there's this nervousness. Well, rates aren't going up, but the economy seems pretty good. What's wrong with the long end? It's waiting for the Fed. It's waiting for normalization. Well, we've begun down that path. Listen, where all the metrics are for the stock market and considering where rates are, I think this is still a very large portion of Goldilocks, personally.
Stephen, the other point in the IMF report is that the US growth is better than a lot of other developed nations. And I guess that plays out in stock market performance too.
If you look at the stock market performance across all different regions globally, we still beat by a large margin every other competitive country. If you believe in the laggards catching up, then you want to be somewhere else. If you believe in the workhorse doing it, then you got to stay in the United States.
Yeah. I was just going to say, I think a big reason for U.S. outperformance is the tech sector, which has obviously been super strong, but don't forget.
Weak lately, so does that continue?
Well, I think that's exactly right. I think the problem that the market is experiencing is if you discount a growth stock at a 10-year rate at 3.5% or 4%, you get a very, very different number than if you discounted at 3%. And that's because we're seeing a rise in short-term and long-term rates. you're affecting the balance sheets of the growth companies, and you're also, on the stock market side, you're affecting the present value of those companies. So I think that's just something to be aware of in terms of the differential between U.S. markets and foreign markets. They just don't have, outside of China,
So
that kind of tech
is what you're
exposure.
saying, just to clarify, as long as rates don't go up too far too fast, then U.S. can lead and technology can lead?
I think that, right, I think for sure, but even I think that there will probably, if there is a rate rise, I just think you'll see the rotation continue out of what's led so far and more into whether it's healthcare, whether it's industrials, whether it's insurance, whether it's banking, just things that might benefit a little bit more from the rate rise.
Final word, Stephen.
So just to talk about rates real quick, Rick talked about rates rising. Everyone thinks the sky's falling. Every housing recovery has happened in a rising rate environment, yet the knee-jerk reaction is to sell all housing stocks. Take a look at it again. I think a lot of it's algo
The
driven.
home builders are getting crushed.
Home builders are getting crushed. But if you look backwards, every other home building recovery has happened in a rising rate environment, because we get back to are they rising for a good reason or bad reason? This market has said there's absolutely no good reason why rates should rise. That's the verdict that it has made thus far.